When and how to raise funding from a VC firm. Money is the make it or break for any startup. If you're starting a company, raising capital is at the top of your priority. Finding the right type of funding depends on what stage you're at and industry you're operating in. Recently, venture capital and angel investing have provided significant financing opportunities for startups in the region. The UAE notably has one of the MENA region's largest startup ecosystems and most active investor community. So is venture capital the right route for your startup? Before jumping in, what are venture capital funds? Venture capitals are professionally managed funds that invest in companies. They usually invest in businesses against equity and exit the investment when the time comes for a third-party acquisition or IPO. VC firms typically look for the next big thing or unicorn. That means high-growth potential startups, mainly, though not exclusively, in high-tech fields. Venture firms are highly selective. They assess the startups from the sustainability and scalability point of view. Key investment criteria often include strong scalability potential, a huge addressable market, and large revenue potential in the long term. They typically look at businesses with a strong team of people and notable traction. Types of VCs, targeting different company stages. A VC investment ticket is generally appropriate for small businesses that are beyond the startup phase and already generating revenues. There are different types of VCs, early stage VCs and later stage VCs. If you want to raise funds from a VC, you must know what type of fund you should be talking to. Of course, there are pros and cons to raising from venture capital firms. Upon investing, VCs generally try to add as much value as possible to the company by providing expertise, mentorship, and more. Ultimately, VC funding could be right for you if you have no experience launching or scaling a startup, are experiencing high growth, and need specific industry expertise and connections. Some of the main advantages of VC funding to keep in mind include: no need to provide personal assets as collateral to raise funds. You'll receive hands-on support from the VC partners and potentially their other portfolio startup founders. VC partners usually build an extensive network of experts to support their investments towards growth and success. VC firms will help you raise subsequent rounds of funding at higher valuation. However, do also consider some of the main disadvantages of VC funding. Funding can be difficult to obtain. The due diligence process can take several months, and VCs can set aggressive terms. At times, the VC's value add may not be transferable to your industry or company. When raising a funding round, you will need to dilute your equity to issue new shares to your investors. When giving too much equity away, you can risk losing the majority ownership in your company, and with it, the control and decision-making power that comes with being a majority founder/shareholder. Weigh the pros and cons carefully. Overall, when dealing with VCs, you'll generally have to be flexible and give up some control. So if you're not interested in too much mentorship or compromise, VC funding may not be your best option. Now that you have a clearer idea of what venture capital funds are, if you're ready to raise funds, then here are a few tips to kickstart your fundraising effort. Contact a wide range of investors you pre-qualified based on your current company stage and build long-term relationships and avoid burning bridges. It's a small industry. Investors tend to share deals and co-invest. Build a pitch and incorporate metrics and your big vision picture. Follow up thoroughly and consistently.